Jeremy, to me, like the big overlapping picture, and maybe your next question is that, what are we really trying to do? We have substantial wealth, we have an open time horizon, an infinite time horizon, and we have an opportunity to grow, compound it, and maybe even perpetuate this kind of wealth. There are certain things we can do about it. And one of the things that I'm very excited about is the fact that you can own a collection of businesses. That's all it comes down to. At the end of the day, this money has to be deployed in a productive way. How do we go about it? And that's where the conversation gets really exciting.
Yeah, that is, and I just love your passion, not only for investing, but the people side of it too. And I think that's really important. It's rare to find that combination of somebody that understands the businesses and has such a deep passion for researching and understanding, the intrinsic value of an individual stock, all the way through to the relationship piece of it. Finding the right client is really important to you, because it's what allows you to be who to work up to your full potential as well. So it sounds like it's a very important relationship, because it's not just a one-way relationship. It requires two people that are both going to kind of do their part, if you will. And in order for you to do what you do best, you need the right kind of mindset and the right partnerships with people. And together, it sounds like there's just, it's so much to unlock. How do you go about choosing the right people?
Welcome to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest topic of all, money. How to make it, save it, keep it. But our conversations lead us to an even bigger question: what it means to live a rich life beyond money. My guests share their practices, principles, and evergreen wisdom. I'm your host, Bogumil, author, TEDx speaker, and investment advisor to wealth creators with patient capital and an infinite investment horizon. I work with families and individuals who aspire to grow wealth over a lifetime and generations through disciplined, thoughtful investments in durable, quality businesses, while giving money meaning. Join me on this quest to unearth and share the wisdom of the ages. Let me share with you the podcast program disclosure statement. Blue Infinitas Capital LLC is a registered investment advisor, and the opinions expressed by the firm's employees and podcast guests on the show are their own and do not reflect the opinions of Blue Infinitas Capital. All the statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. The information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. The information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. None of what you're about to hear is investment advice. Well, hello everyone. I have Jeremy Deal on the show, and it's a different episode today because it's a fireside chat where Jeremy, who was a guest on the show, came back and he will ask me questions. And you have to look up Jeremy's episode because Jeremy is a fascinating investor, born in the US, spending quite a bit of time in Europe. And I see you as this very sharp mind. And we've been in the room together so many times where I felt like Jeremy's observations are the most accurate and well-timed. So I'm really, really curious what kind of questions you have for me and what's going on in your mind. So thank you for coming back on the show.
Yeah, thank you, Bogumil. Great to see you again. I think I saw you somewhat recently in Virginia.
At yes, where our friend Jeff Henriksen hosted an event. In an old bank building.
Yes, that's right.
We sitting in a
Sorry, we had such a great conversation over dinner, and
Huh?
it was just really neat to be able to see you in America after recently having seen you in Switzerland. And yeah, it's really nice to have you to see you on the circuit, so to speak, the value investor circuit.
Yeah, it's the venue was really special. I love old banks, and this was an old bank converted into a co-working space, and it had a beautiful old vault. I don't know if you got to see it.
Yes,
If
yeah,
those walls could speak, I'd love to hear the story.
yeah. Back when they probably stored from floor to ceiling with cash and gold and
Huh?
all kinds of stuff, and today it's just an electronic transfer, or better off, just an office. But yeah, but thanks for having me on. And I first wanted to start by saying, hey, congratulations on the move to being independent.
Mhm.
And I'm really excited to ask you about that and about the wealth management and industry, the broader industry, and yeah, just looking forward to chatting. So
Let's
with
do it.
that, yeah. So first of all, congratulations on
Thank you.
becoming independent. What's it like? How long has it been, and how is it for the first, I don't know, the first few months been? How, is it? Do you feel any different? Is it like becoming a year older, where people ask you, is it really different to be 29 instead of 28? You say, no, I don't really feel that much different. So do you feel different?
I do. I do. I feel like it's like a new wave of excitement and inspiration. And I've been in the business 20 years. I'm 44. And I feel like the time flew by. So I spent a little over one half with one firm that we grew from 40 people to 130, 140 maybe. It was a great place to learn, a very value investment focused, managing money for families. And then with a few partners, I co-founded another firm where I spent 8 years. We had a lot of fun as well. Similar focus, similar clientele. And I was thinking about the next, and I was thinking, should I say next half or next one, and 2/3? I was thinking of Munger the other day when he was my age. He was just warming up and he had, 2/3 of the runway or more ahead of him. So I hope I can channel the same kind of runway. But I was thinking about the next 20 years, to be honest with you. And I was thinking what kind of arrangement, business structure I would like to have. And there's a lot of power. It's very empowering to be independent because you get to choose everything. I've been fortunate to attract the clientele that wants to work with me, and these are families with very patient capital, multi-generational wealth, and they have a open-ended, I call it an infinite horizon, and hence the name of the firm, Blue Infinitas Capital. I wanted the word infinity in there. Blue because it's an open horizon, opportunities ahead. I sail, I fly planes, and I always think of a blue horizon ahead of me as this inspiring open-ended opportunity. And then infinitas it's a Latin word, it means infinity, but it's a classical language. Some people say it's a dead language. So I wanted to give homage to the past, because any fortune you look at, you have to respect the past, but you're also looking at infinity, which is ahead of you, which is the future, the opportunities that are yet to come. So I love the fact that we're thinking about the past, respecting it, but we're very firmly present here right now with our feet on the ground, and then looking ahead what those fortunes could be in the coming decades. And in my mind, a family fortune, it's a miracle. If it's here, if it's substantial, if it's been around for a few generations, even more so, but even a lifetime, it's a miracle, and it's up against so many different challenges. But also it creates some unique opportunities ahead. You can take your time, you're in no rush, you have the capital, right? The one thing you don't want is to lose it, and then you can put it to work over time. So I'm very excited to work with the clients that I'm attracting. And as I mentioned it to you, I take my time onboarding new clients, and I see these as lifelong relationships. So anybody new that comes in, I'd love to get to know them better. And we have a lot of frank, open conversations when I want to understand if I'm the right fit, if they're the right fit. And if it's the case, then I'm very open with them, and I say, I think you should be a client.
Yeah,
And that's
and
where it starts.
on that note, yeah, thank you for that. That's great background. On that note, can you talk a little bit about the broader wealth management industry? I run a fund. You don't have your business isn't that different from a fund manager. And but within wealth management and I put myself in that industry, we're all kind of managing money. We all do it a little bit differently. There may be different strategies, different legal structures, but speaking, saying that we're kind of all in that, we're both in that industry. You talk a little bit about how what is the wealth management and how has it changed? What's happening in the wealth management today, and where do you fit in? And maybe because it is a little bit confusing, like it. If I think about some of the high net worth investors in our fund, sometimes they have a wealth manager that they work with. Sometimes they have somebody helping them. Sometimes they don't. And I've also met a lot of people that have recently come into money. I'm sure very similar to your clients as well. And there's a little bit of confusion sometimes, like what am I supposed to do with this? Can you talk a little bit about how the industry's changed, how it's
Mm-hmm.
evolving,
Mm-hmm.
and where you fit in?
So it's a wide range, and let me start in the very, very middle. So I'll tell you where I belong with the business that I have. So I see myself as an investment manager, money manager, portfolio manager, first of all, and a stock picker, right? So on one hand, I do build an actual portfolio of 30 some stocks. I know the businesses we own. I know the companies. I know the managements. I build the portfolio, and it rhymes a lot with what you do. I take a long-term view as well, and I have to bridge it with whose money am I managing? And it's something that's not talked about. So you might have a long-term disciplined investment approach, but you also have to align it with the right client. And over the last 20 years and early on in my career, I already realized that the clients that the firm where I was and that I've worked with over the years had in common was that they could take a long-term view as well, right? So it's not just that the investment approach was long-term, but the clients could take a long-term view. And then I realized that these are families with certain wealth that could be committed for 5, 10, and 20 years and more, and permanent capital. So you and I, in that sense, our stories rhyme because we both want to buy stakes in businesses, hold on to them for a while, but we need partners in this process and the clients that can wait with us and can patiently see the results over time. So my big difference, so to speak, and compared to many others, is that I know the clients, I know the families, I know the names, I know the kids, I knew the grandparents in many cases. So there's nobody between us. I don't have to call somebody to talk to them. They don't have to call somebody to talk to me. We can just openly talk, and I'm as close as possible to them, and that helps me make better investment decisions for them. On the other side, I know the businesses we hold. I don't have to call somebody who will call somebody who will call somebody and tell me why this particular stock or holding is in the portfolio. I know why it's in the portfolio. I'm the one who made the decision. I'm the one that made the purchase. I can tell you the time, the price I paid. So I love the fact that there's no middleman on either side.
The traditional sense of when I think maybe maybe past generations think about our parents' generation, for example, thinks about wealth management. They think about, the guy with the suit and the Morgan Stanley office or the Goldman Sachs tower, and they go in and they sit down and maybe they talk about financial goals, but actually that account is really handed off to someone else, where it's invested in various funds that that big institution may manage, and the person that you're in contact with is just a relationship manager. And in some cases, that relationship is valuable because they can make introductions or get you in other funds, for example. But what you're saying is really interesting because you're saying, look, by being independent, by being small, by being focused, I can actually manage the money myself. Is what you're saying. There's no group of people that you're handing the money to. There's no team that you need to consult with to say, well, let's buy this or oh, we can't buy that. Does that meet certain parameters? You could look up and say, I know a handful of companies really well, and the only thing between buying more maybe is just talking to the client and not necessarily needing to get a bigger picture approval. Would you say that's
That's
a way to think
absolutely
about it?
fair.
Yeah.
And I think what you're pointing out, that there's a range, right? Even when, well, let's first look at the problem. The problem is you have somebody who just inherited or received in some way substantial wealth, overwhelming wealth. Let's call it a fortune, a life-changing amount. And whether they knew that it's coming, like some of the clients, potential clients I talked to this week, they knew, well, they've known for a while that a substantial amount is coming. It's about to come to them. So they have the time to think about it and decide what to do. But it's a real problem because you're overnight responsible for a large amount that could change your life. It could change the life of your kids and maybe your grandkids. Maybe it could help charities that are in your life, or nieces and nephews, and broader circle that's around you in so many ways, your family. And they have to make some choices. And I write about it quite a bit, that there is no dress rehearsal. It's not like we'll try with this amount and then we'll figure it out and then we'll try it with the next one. I jokingly bring up a wonderful book. It's called Brewster's Millions. It's a 100-year-old novel, and it's a story that you might be familiar with because it was turned into a movie, but the book is so much better. And the book it's a wonderful read for anybody that's about to experience sudden wealth, one way or the other. And there are more people that will experience this in our lifetime than ever before, for many reasons, right? Inheritance is one of them, sale of businesses, big pay packages. There's so many different ways that people will experience that. In that playful book, they tell a story, the author tells a story of Brewster, who receives one inheritance and he has to lose it all. Not as in, spend it on houses. He actually has to lose it all, part with it completely, so that he can receive the second inheritance. It's basically two family members, setting some sort of a family feud with this setup for this young man. Anyways, without giving too much away, he learns a lot through the experience of losing, doing all the wrong things. The funny thing is that he actually makes some bad investments that turn out okay. There's some, as you know, poorly chosen stocks that go up and give you the wrong feedback. So he actually tries to lose money and he makes money, right? But he eventually loses the money and he's finally ready to face the second inheritance. What I do tell clients and prospects is that in life, it doesn't work that way. You might not have a second chance and a larger inheritance coming your way. This is it. And if this is it, I would look around, ask, investigate, research, all the help you can find on so many levels, including a money manager and investment advisor that can guide you in the process, because it's a huge responsibility that you're about to face. And unless you choose this as your new obsession, your new calling, and you want to do it full time, then by all means do it. There's so many people that do it day in, day out. They live to do it, they breathe to do it, like I do, for example, that I've seen it 1,000 times with so many families. And somebody that has the experience can be really, really helpful in this moment to guide you in the process. But back to your point, there's a wide range of interactions that people can have, even facing this problem. They can go to a firm where they talk to a relationship manager that will allocate that to other managers that allocate it to different products and strategies within the firm, outside the firm. There's so many setups. The more I ask, even last week I was talking to somebody who has a certain family office setup, and we were talking, there are more ways to set it up than you can imagine, right? So, and it's basically the degrees of separation. If I was to say, like, what's different, it's the degrees of separation. On one hand, how far away are you from the actual client? On the other hand, how far are you away from the actual investment? And when I say investment, I don't mean, value, growth, strategy, 2.0, whatever it is. I'm talking about the actual holding with a name, with the CEO and the product, and like I'm talking. If we were say Coca-Cola, Buffett brought up Coca-Cola a million times. So let's say that you own Coca-Cola. That's it.
Yes,
it doesn't matter that it's part of this strategy or that strategy. You're a shareholder of a business. But Jeremy, to me, like the big overlapping picture, and maybe your next question is that, what are we really trying to do? We have substantial wealth, we have an open time horizon, an infinite time horizon, and we have an opportunity to grow, compound it, and maybe even perpetuate this kind of wealth. There are certain things we can do about it, and one of the things that I'm very excited about is the fact that you can own a collection of businesses That's all it comes down to. How you will own them through how many strategies and layers and products, that's a different question. But at the end of the day, this money has to be deployed in a productive way. How do we go about it? And that's where the conversation gets really exciting.
Yeah, that is, and I just love your passion, not only for investing, but the people side of it too. And I think that's really important. It's rare to find that combination of somebody that understands the businesses and has such a deep passion for researching and understanding the intrinsic value of an individual stock, all the way through to the relationship piece of it and understanding that. So that's really fascinating. It sounds like the finding the right client is really important to you, because it's what allows you to be who to work up to your full potential as well. So it sounds like it's a very important relationship, because it's not just a one-way relationship. It requires two people that are both going to kind of do their part, if you will. And in order for you to do what you do best, you need the right kind of mindset and the right partnerships with people. And together, it sounds like there's just, it's so much to unlock. How do you go about choosing the right people? And what is your process like for making sure that only the people that deserve you and you deserve them? What's the process to ensure that you only working with the right I
think it's a wonderful question, and I'm very deliberate and diligent about it. And there's a handful of people that have known me for a long time that I enjoy working with, and then there are new ones that I'm getting to know. And I find it very exciting to get to know new families. And there are people that come to me and they share their stories, and whether it's because of the podcast or the books or my articles, and they feel like they already know me because they've either heard my voice or read my words, and I share my personal story and as well, and they can relate to it and what I've been trying to accomplish in the field. And I give myself time to get to know them. So we have one call and another call, and sometimes I get to meet them in person. I like that. It doesn't always happen. We meet at some point in person and not necessarily, right away. But I do my best to commit as much time as possible to give both sides a chance to get to know each other. And I'm very slow about onboarding clients, but if I come across somebody that I feel like this is the right fit, I'm very open and I say, you should be a client. And then I see it as a lifelong relationship. So I'd rather spend a lot of extra time ahead before we actually onboard and start than to realize down the road that we speak a different language. I do have to tell you that I find it very helpful on an emotional, psychological level to live through a market correction together. And I think there's no secret to it that if we're embarking on a multi-decade investment journey together, there will be hiccups. There will be market-wide, sell-offs. There will be some segments of the markets that will drop off. There will be all kinds of, crises. And even in the last 20 years, we had the major ones, obviously, but a lot of small ones, even, the summer jitters that the people experience. So we can sit down and talk about what it feels like, but to actually see how we both react in that moment, I think it's very eye-opening. And I do have vivid memories of my existing clients in March 2020, and I mentioned that to you on some occasion, how they would ask for a phone call in March of 2020. And I was busy. I was looking at stocks and going down my wish list and buying a lot of stocks. They were at 5, 10, 20-year lows. They were coming to me instead of me chasing them. And they would tell me, Jeremy, I just wanted to hear your voice. I know you're buying, so I'll let you get back to it. I just wanted to hear your voice. And they were almost like smiling through their voice because they knew what I'm up to. And they knew that I'm excited and I'm looking for things. And I thought I've done the right job, so they're not surprised what I'm doing. But I do respect the fact that they want to hear my voice. And that's absolutely fine. And I made myself as available as I could, and I would do it all over again. I think it's precious. It's like seeing a doctor before you go in for a surgery. You want them to hold your hand for a second and say, Jeremy, everything will be fine. The nurse is prepped. The room is prepped. We talked about it. I'll see you on the other side. And I grew up with two parents, doctors in my household. I have, very vivid memories of that. And I feel like my role in many ways is the money family doctor, where you go in and you hold somebody's hand through a tough time. And I can do that because I know the client, and I can do that because I know the holdings. There's nobody else I have to call to make that, connection and explanation happen. It's actually, the most efficient, direct way that I can imagine. I can't actually see any other way of doing it. I wanted to point out that maybe, we all experience world in our own way because of the singular path we took. But the people I've worked with and the managers I knew in my direct line, I'm thinking of, certain intellectual heritage, they've all thought the way I describe managing money. And the people that trained them, that date back, some of them worked with people that were in the business during the Great Depression. They also thought that way. So in this very wide range of outcomes, there is this line, intellectual, thread that goes back generations of people that manage money for families, that owned actual stocks and owned them with the purpose of, being actual business owners and benefiting from compounding and so on, in this context of serving those families. And I see that still present in the US. I see it also in Europe. There are quite a few people that I have a lot of respect for, that I admire, that do the exact same thing, where they know the clients, they know the holdings. They're not trying to do everything for everybody, but this particular approach, this particular model resonates with enough people so that they can pursue the passion that they have. When I think of it as like a dream money manager, you want somebody that's absolutely obsessed with the pursuit, not just stock picking, but actually managing a family fortune, and somebody that would do it even if they were not paid for it. I mean, I jokingly say it, but I would do what I do even if I wasn't paid for it. And I'm very grateful that I do get paid for it, and I think it's wonderful.
Yeah,
but
Buffett talks about that too,
right?
And
if you have somebody that does it only for the money, it's a whole different, dynamic. And you do want to have somebody that cares. You want somebody that's actually so invested in the family's success that they care. They know your name, they know your story, they know the context. It's just like a doctor. You can go to 1 million doctors and say, you had 1,000 different experiences, but there was somebody there that knew your name, knew your story, and you felt like, of course he's competent or she's competent, but on top of it, I feel like I'm taken care of. And that's the experience that I want them to have.
So I wanted to ask you about something I've always been interested in. When you're managing a fund, the client gets a statement at the end of the month, and they're up or down or whatever, and it shows their returns. When you're managing a separately managed account,
yes,
they can look in and see the account. They can see it moving day to day. They can see what you own. There's that transparency. How do you manage the anxiety that somebody has towards, you don't really necessarily know if somebody's logging in and looking or not. I'm sure there's some people that log in and look and say, oh, wow, we're down a lot today, or we're up a lot today. Or when you decide to buy something and sell something, how do you manage that anxiety that a family may have, or the differences between two different clients? So let's say one client, it's really important for them to try to beat the market, and then there's another client that says, look, I can't handle the volatility. How do you manage those relationships and the expectations when everybody can see what's going on all the time? They can see how the sausage is made, so to speak.
It's a great point on so many levels. So first of all, as you pointed out, a separately managed account, you have full access, transparency. If I bought a stock yesterday, you'll see it tomorrow or even tonight through your app, through the website. And I think, it's great and it's helpful to some extent. What you will also experience is that you will see the portfolio move every day. And we can have, 1 or 2% move every day. And that has an impact, an emotional impact. So I think we learn a lot about each other. I don't check prices of my stocks unless I'm here to buy, or I'm thinking about trimming or selling, between that, if you ask me about any particular holding, I kind of have a range. I think it's still in the 70s somewhere, but Jeremy, I have to check. So I'm not personally watching them. I do know that my clients, some of them check in now and then, and they say, oh, wow, we reached this milestone. And I know that some look at it more. They ask me what's the right amount of frequency, how frequently they should look. And I say whatever allows you, to both feel comfortable with what we have, and second, that gives you peace of mind and you can sleep well at night. But I think checking it day to day, it doesn't really help. But you're right that this setup invites a lot more, attention and feedback. But if they know what we're doing and why we hold it, and we've had this ongoing conversation, I'm really full of admiration how the clients I've enjoyed working with, that they don't pay attention to it. They want to grow their wealth over time. They don't want to risk losing a big portion of it as we go. The volatility comes and goes. Given the collection of businesses that we have, I tend to believe that we trend below the market volatility, but that's not a rule. And it's not even an aspiration. I feel like because they're quality businesses with, real products, real services, real profits, and, solid long-term strategy, they're not hopping around a lot day to day as maybe some of the most exciting stocks with no profits and all just, story that these do. So that's the benefit to it. And it's a selected group of stocks that they're familiar with, that we've talked about. And so it's an ongoing process. I do think, even, me personally, that I get to check the price every day if I wanted to and throughout the day. I don't find it helpful. And I just tell clients it's not helpful. But you make a really good point that it's part of this ongoing, education conversation and acceptance that this is the money that's committed for the long run.
Yeah, and it sounds like this is the opportunity to work with you is you're deeply familiar with, like you said, 30 or 40 stocks or maybe even 50 stocks, plus you have a watch list. Mm-hmm. And so that allows you to take some or all of them at any given time for any different client. And that is enough to produce excellent results over time. And so it sounds like what you can do is say, okay, I know these, let's call it 30 to 50 companies. And for this client, we want to own all 30 of these. Or for this other client, we want to own 30 of these. And for another client, we want to own maybe 25 of these. Or maybe there's another client who wants that we should put her in all 50 of these, and I understand, and kind of move them around. Is that how you think about managing the portfolio? Or does everybody get roughly the same allocation to the same portfolio, and as you make adjustments, everybody gets that adjustment?
So the aspiration is that everybody owns the same stocks. Now, okay. the timing of the arrival of the cash and the assets, and if there are additions and so on, can create some differences. And if there are special requests, which I accommodate, and somebody doesn't want to be in a particular sector, then I can make a note. And these days with trading tools, I can exclude certain accounts from certain securities. That can happen. But it's a handful of cases that I can think of. If this stock is good for me, it's good for the clients, then it's good for all the clients, and the other way around, right? If it's good for all, then it's good for one, then it's good for me. Yes. Now, it may differ. And I think philosophically, the difference between a separately managed account and a fund is that if a new $10 million arrives to a fund, you basically start to participate in the same makeup, in the same portfolio as everybody has so far. 2% of this, 10% of that, 5% of this, same makeup. It can, if it's a large contribution, obviously the weights will start to differ a bit. It will be reshuffled a bit. But you basically become an owner in the 10, 20, 50, or 100 stocks that the fund has had so far, right? You join. And some of those holdings, and I asked that many managers how they think about it, but some of the holdings, like in my case, they're 10 or 12-year-old holdings. They've been around. And they can be a multiple of what we paid for. And, if new money comes in, I think it's, physics or however you look at it, that the upside is not as attractive as it was when we initially bought it for some of the holdings. I think you have to be, intellectually honest with yourself. So I have that choice of both allowing new clients to participate in new purchases, like we're buying, 1% or 2% of this particular holding for all of the clients at the same time, and the new ones as well. But the past holdings, I have the flexibility to add those so they start to match up over time. So I can do that. That's why the accounts eventually will align, but not immediately. It gives clients some peace of mind. Actually, there was a prospect I talked to this week that was asking specifically about that, because there's always the question, is the market high, is the market low? And I feel like philosophically, if you want to participate in the ownership of businesses through the stock market, which is a place where you can buy small participation, small pieces of businesses, if philosophically you think that's where you belong and you want to participate in this, then the decision is done. It's yes. Now, how do we go about it? We can gradually put the money to work. We can work out a strategy to merge you with everybody else over time. We can start buying new ideas with everybody else, which I think it's the ideal situation. And then we can add the previous holdings that still make sense over time. Now, some of those past holdings might be on the way out, so I'm not going to buy them in the new accounts. I don't have to just force them into some sort of a model. But we have that flexibility, and with trading tools these days, you can nicely navigate that allocation. And truth be told, that this gives me and the client a lot of freedom and flexibility to join the market. It's like I see the market as a moving train in a way. You're trying to hop on. How do you hop on without hurting yourself, right? And everybody looks back and says, I wish I started investing 10 years ago or 20 years ago. But it's like that Chinese proverb, planting a tree. You haven't planted it 20 years ago. Guess what? Today is the second best day. So you have to start. But it doesn't mean you have to go all in. I have a specific story that comes to mind when you asked the question. I had a client that I started speaking with in late 2019. And then we got serious about onboarding in January 2020. And the market was, flying high. The margins were like peak levels, unemployment record low. It just looked like a picture perfect. And I actually took some money off the table for clients at that time. So we built up a cash position at the time. And anyways, but she asked the question that people would ask any other time, where, what are we going to do? And I said, we're going to buy a few holdings, and then we're going to wait. And February came, and there were a few more things, Jeremy, that I could buy. And then March 2020 came, and I had a call with her, and I said, we're going to go ahead and put majority of your account to work, because I'm seeing opportunities I haven't seen in years, right? So it's an ongoing, flexible conversation that in January it sounds different than in March. And I think at any point in time, you have to acknowledge that in the next 3 months, we might be facing a very different set of circumstances. And I'd like to be able to adapt and take advantage of what's coming.
Yeah, that's always the hard part is, either markets seem expensive or people are afraid of them continuing to go down when they're going down. So you're always, damned if you do, damned if you don't. There's never, I tell people there's never a good time to invest. There's always a reason not to invest. There's always a reason to delay. It's never a good time. You're either afraid that it's going to keep going down, or it's going to go down because you paid too, or because the markets are high or whatever. So I think you're right. You have to find the business. You have to first have the mindset that I want to be an owner of this business or these businesses.
That's right.
And the journey of business ownership means that there's going to be periods of time where the business that you own is going to be fairly valued, even slightly overvalued, even sometimes very overvalued. And it's also going to go through periods of time where it's very undervalued. And so that's just the journey of it. If you you mentioned Coca-Cola earlier. If you think about Coca-Cola's 100+ year history as a public company, I forgot what year it went public, but if you had tried to time, when do I get in and when do I get out, and you really had that 100-year time horizon, you probably wouldn't have done that well. And I remember reading something talking about how Coca-Cola tanked, during the onset of World War II.
Mm.
But in actuality, it was such a great buy because Coca-Cola expanded quite a bit because they included it in the GI meal kit. And I think they
Wow.
also included other drinks as well, but I know Coca-Cola was included in there. And it turned out that, yeah, you didn't know when the war was going to end. You didn't really know the impact on the US economy or the global economy. But if you would have just held on, or yeah, of course, bought at the bottom, but even if you had just never sold and just dealt with that volatility, you would have made multiples more on your money than you could have made doing the typical kind of investments. I think that very high net worth people at that time would think about doing, maybe buying more land or things that just didn't pay a dividend or couldn't cover their own expenses. It was just an incredible machine. People are very also quick to judge Buffett for those periods of time where there was a statement that he made that said, well, if I was running the partnership, maybe I would have sold Coke at the top, whatever year that
Hmm.
was, early
Hmm.
2000s, and then maybe bought it back later. And there was a period of time where it didn't do anything at all. But because it's sitting in a C Corp inside Berkshire, we just held it. And well, okay. And people love to make that argument for saying, yes, you should look out for times to maybe sell and buy back. And maybe that's right for certain stocks and for certain clients. But for taxable people especially, when you own the right business, you're actually better off by just letting it compound and letting it do its thing and focusing more on the underlying intrinsic value that's being created, and maybe the terminal value, so to speak, that's being created, more so than what's the PE ratio today relative to the market or relative to, next quarter's earnings. Because even in that Buffett example where he says, yeah, I would have been better off selling it if the stock would have been in the partnership, I would have sold it. It hasn't turned out that bad at all. Actually, it's been a huge home run for Buffett and for Berkshire shareholders to continue have held Coca-Cola, even though there were several years where it underperformed.
Hmm.
And I believe today the dividends that Berkshire shareholders receive from Coca-Cola are greater than what Buffett paid for the stock initially, or close to it, if not exceeded. So you're absolutely right that there is no good time. You just have to you have to make sure you find the businesses that you want to own and know why you want to own them. And I think on that, I mean, my next question would be, um, can you talk about some times where it's been difficult, where the volatility, where the anxiety, where the markets in the world was just falling apart and things were just collapsing? I know you mentioned it earlier a little bit, March 2020. Um, but what can you give maybe an example of how you dealt with a client and what you told them and how it turned out during that stressful period, or during any stressful period in the market?
I think it's a terrific question, and I'll say one sentence. I want to talk about Coca-Cola before I tell you more, but I found when you talk about those difficult periods that it's not really the market sell-offs that were hard. It's actually the bull markets, the undeserved bull markets, that are harder on some clients. And I'll come back to it in a second, but I'll just hint it. You must have read my mind because I made a note to myself, I don't know related to what, about Coca-Cola. I asked myself this question the last 100 years. I like this idea of 100 years as a time horizon. Infinite is the aspiration, but I think I even asked Buffett at Omaha's meeting last year about a 100-year vision of Berkshire. But 100 years ago, Coca-Cola, and I looked it up before this conversation, not knowing you're going to ask about it, was a $40 stock, 1919, 1920 something, $40 stock. And that meant that you could buy 2 ounces of gold at the time. Now, that $40 would have been 15, as in $15 million today, 100 some years later. Now, gold is $2,500 per ounce, right? So you would have had, 2 ounces of gold, $5,000. Clearly, owning Coca-Cola has been a better investment than owning gold, although I think there are periods when gold can play a role in wealth preservation, but that's a side note. But just to have some point of a reference. the last 100 years with Coca-Cola as an example, and it's not an endorsement, it's just a case study, what it has done. And you could try to play the same game with the Dow or any index and say what it has done over that period of time. The trouble or the trick with the index is that the companies that were in the index in 1919 are no longer with us, right? Like that's why the index is kind of you're not comparing apples to apples, you're comparing it to different. But the bigger picture that you brought up, I don't know if you're familiar with Nick Murray. Nick Murray has been this proponent of stock investing and wrote wonderful books. But his point is that once you make up your mind that you want to participate in that value creation that comes from ownership of businesses, that's it. And he makes this argument you should own stocks instead of bonds. And he makes an argument that you do need an advisor to hold your hand for tough times. And I think Nick Murray has something to say on that topic. I was actually introduced to Nick Murray by one of my listeners from the UK. And I highly recommend his writings. But he makes a point that if you take a lifetime of a person and take even the multiple that the S&P 500 has made or done, it's staggering that how many times you could have made your money if you started investing at the age of 1, right? And now, of course, we talked about this tree planted 20 years ago. Maybe you haven't planted it, but you still have the next 20 years. And then your kids have the following 20 years. You have this compounding machine. And the big picture that I want to mention, when people talk about value creation, for me, it's the entrepreneurial spirit. And in America, it's very present, but in some other places, it's present too. So what you're doing as a stock investor, you're tapping into this entrepreneurial spirit that's out there. And it's not set in stone. New businesses will be listed and new businesses you and I will get to own and our clients will benefit from, right? So it's this beautiful setup that Jeremy and Bogumil doesn't have to come up with the next NVIDIA, but there will be businesses that will get listed in our lifetime that we can't even think of as we speak today, that you and I will have the opportunity to buy and participate in, right? The trick is not to overpay for them and to hold them for long enough so the benefits come. So that's the big picture. Last thing I want to say is a lot of people look at investing and, let's talk about value investing for a second as this, static point of view that there's this intrinsic value, $50. You bought it at 25, you reach 50 and you walk away. I like the more dynamic view that you bought a business that was worth, $50 as Coca-Cola was $40 per share in 1919. But look, through compounding, this became a $15 million pot of money after 100 years. So when you think about the investment, it's not just what it is worth today, but what it could be worth, 50 or 100 years from now. And when I look at a family fortune and somebody says, I have 50 million, I'm thinking, imagine for a second of what that 50 million could be after 20 years of some decent compounding. And I'm not saying, some eye-popping, promises. There are no promises, and I think everybody is aware that, there are risks in investing. But if you buy quality businesses, hold them over the long run, the odds are in your favor that you're going to compound it at some respectable rate, probably a wide range. But that image for a second of what this wealth could be in 50 years, that's what I get excited about, and how much it can impact and change people's lives. And I hear stories of people could take gap years, kids could go to schools, pursue careers that are not financially rewarding, but they love what they want to do. I mean, all those little stories make what I do worthwhile because I realize what a huge, far-reaching impact that capital can have. And sometimes I say that even the fact that money is there, they know it's there, and they don't even touch it, it gives them such an emotional peace of mind that they get to go about their day, say no to a boss, say no to this opportunity because the money is there, right? Like, how can you put a price on it, right? It's an intangible benefit. But back to your point, volatility, anxiety, and the hardest times. I found that actually during market sell-offs, the clients I worked with, they were already so prepared and primed that something like this can happen. And it's an ongoing conversation. I even sent my clients an email in August of 2024 without timestamping too much this episode. But I felt at the end of the day when we had some market jitters and I think it was the biggest correction, mini correction in NASDAQ in the last 9 months or 12 months. I don't even know. But I felt like I'll write an email. And they all within minutes responded saying, of course, like we know, but we appreciate you wrote it. But I thought, and I said, if you want to talk about it, I said, no, there's nothing to talk about. It's fine. So I feel like this preparation doesn't happen with one email and one conversation, right? It's something that you build up. It's a certain trust that they know that you're watching, you're on top of it, and you're acting on it. But I do want to highlight that I found that period that followed the pandemic sell-off much, much harder emotionally, psychologically on a lot of people that I know and respect and familiar with their stories, that it was such a trying period for a lot of people in this profession and their clients, because people were feeling like they're missing out. And somehow it's such a powerful emotion where your neighbor's getting richer faster than you are. And I think even JP Morgan, not the bank, the individual, said it years ago, how this is something that lost more money for people than anything else. The fact that your neighbors are getting richer faster than you are. So we were experiencing this right after the worst of the pandemic, when people got so excited about the future. We were buying businesses with no profits. We were buying assets with just imaginary assets, I would call them. And we thought that there are easy riches wherever you go. And I think it was getting to people. And I know some people that are very wise that had some unwise ideas at that time. And they were trying to run these ideas by me. And they knew what I will say. That these are not good ideas, no matter what the context is. And I recently had Peter Atwater on the show, and he wrote a book, Confidence Map. And he has a remarkable point, so many points in this book. I think it's a wonderful book that kind of gives you a framework of thinking about, certainty and control. But he has one point about time horizon. He says that when we're comfortable and at peace and excited, our time horizon expands. It's not a static perception of time horizon, actually. And during that period, people were willing to commit money for the long run, capital, different lockups in different funds. They were excited about something that will happen in so many years, just imaginary stories and so on. Now, when things get difficult and when they panic, their time horizon shrinks to the point that they can't even think about tomorrow. And he points out when COVID was starting out and we had lockdowns, people didn't know what tomorrow will look like. Will I go to the office or not? Will I be able to see my grandpa or not? So our time horizon shrinks so much on so many levels in times of panic. So when people say, what's your time horizon? It's not a fair question, because your time horizon, even like perception of it, will evolve. And there will be moments when you want to know that there's $1 million in cash at the bank ready to use. And there will be times when that million belongs in a collection of businesses committed for 10 years, right? So you have to be very understanding and empathetic and compassionate about this journey that your clients are on, because the time horizon, it's not set in stone. It's not something you check off on the form and you say, my time horizon is 5 years. No, it's something we have to continue to talk about so that I know where you are, where we are.
And it goes back to what you said earlier about the ability to get to know the business. And that's a big value add, because you're going to spend an enormous amount of time, or you spend an enormous amount of time getting to know a handful of businesses well. That is what allows you to be able to hold when money that doesn't necessarily know doesn't know what they own are forced to sell. It gives you the confidence to hold when others can't. And it also gives you the confidence to be able to sell when the thesis changes. And I think that's really what matters. What it's not doing is saying, oh, we're going to sell it based on the price movement, and because we're trying to smooth out the returns and the volatility. Sounds like what you're really offering is the opportunity to be a conduit to understanding these businesses in a way that you need to understand them from a business perspective, from an investment perspective. So not necessarily working at the business per se, but well enough to be able to hold. And that's 99% of it. That's 99% of the problem. It's not that clients, especially clients that have been very successful in business, of course, they're exceptional in business and they have exceptional talent and they can understand anything. Or they can understand most business models, and whatever they don't understand, they can learn. It's not necessarily like Buffett says, you don't need 140 IQ to be great in this business. It's more of an emotional IQ that comes from getting to know a business well enough to know when Mr. Market has it wrong. And that's more valuable than, and I mean, that's a very valuable tool to have. And what I think what you offer, because otherwise, most people just let price determine if they want to buy more or sell more. So the price goes down, they think, oh, it was a mistake. It's down for more than XYZ period of time. I have my rule, I have my discipline, I sell it. Or they say, oh, the price is up, it's gone up more than X percent, and my discipline says I sell it this, or it's become this percentage of the portfolio. They're not making decisions based on the fundamentals of the business relative to the fundamentals of the other businesses in the portfolio. And that's, I think, something that can only be done well if it's something you're extremely passionate about and have experience doing and want to do all the time. It's not something it's not a job where you clock in and clock out. You're always on, you're always thinking. And your passion for this really rings through and is obvious and clear. But that seems like a lot of the value you bring to the table is that knowledge, to be able to do the rational thing when the markets are not being rational.
I strongly believe that you can't outsource conviction. If you show me a list of companies that another manager owns that I even respect, I can't borrow.
By the way, a mutual friend of ours says you can't transfer conviction. I won't say his name here, but somebody we both know, and it's a saying I use all the time.
That's right.
And it is so true. You cannot transfer conviction.
No. And, there's a catch here because some funds have, public holdings and you can look them up. In the US, it's the case and you can regularly look up. But if you show me somebody's holdings, and even if I know the name, even if I know quite a bit about the person, if I know the person even, I have more of a context. So you show me, 10 of their stocks. Some people have the process that they buy even 100 shares of something because they're thinking about it. It has no bearing on them ever buying more of it. Some people go in and buy a whole position right away. Some people are just testing the waters and might actually sell it in the next quarter. So you have to have so much context, even if you know that Jeremy bought this stock. I want to know so much more, right? So to me, I never really found it helpful. And it never gave me any, undeserved comfort that somebody else is buying what I bought. I mean, in a certain way, I would say that, I remember pitching an idea as a junior analyst to a group of seasoned managers back at the firm where I started, and somehow my contrarian bone would kick in. So if I had a room of people and I found something that really made sense to me and everybody agreed with me, I thought I immediately was quickly losing interest. I felt like that's not okay. I want something that people feel uncomfortable on some level because it's a good proxy for the market. Like I'm getting a deal, I'm getting a bargain. I call myself a value buyer and a growth holder. I want to get a deal. I want to go in when people get spooked. I want to look up for situations when it's down cheap out of favor kind of stock, but still quality management, quality business, quality prospects or good prospects. But when everybody agreed with me, so if you show me, look, the other 20 managers are buying what you're buying, I would have thought that I think I either missed the boat or it's just way too much of a consensus buy. You have to buy when people are uncomfortable. Be greedy when people are fearful. Buffett told us that. So that's a fascinating thing. I think when people think of the stock market, let's say what it is. It's a market. It's a place where you go buy things. And you can walk around the market the same way in some places. When my wife and I travel, we love to go to a local market and see what people sell, like what kind of fruit, what kind of vegetables, what kind of products they have. And you walk around and you can leave that market without anything. You don't have to buy anything, right? It's just a place. So people get excited about it and have all the stories about it. It's just a place. It just happens to be such a phenomenal invention that's a few hundred years old that allows us to become minority shareholders in other people's businesses. It's such a mind-blowing idea that you will be treated fairly and equally as anybody else. And it's not the case everywhere. You and I know that. But in enough markets and with enough disclosure regulation, but also culture, we have developed this universe of business participation. Like you walk around your town and you see a coffee shop and you see that it's successful. You knock on the door, you talk to the manager and you say, Bob, I'd love to own a quarter of your business. He's going to say, no, it's for me and my sister. We're running it. We put on, sweat equity in this. And Jeremy's not going to become a 25% owner in this, right? And that's how most of business has existed throughout most of human history. If you had a successful, silk trading operation, 1,000 years ago, it was you, your uncle, your buddy. And if I came in and I said, I'd love for you guys to take me with you on your, silk trading route, you would say no. At some point, and I think it was the scale, and it's the Dutch Republic with Florence and every other, change in accounting and all those things that were developing at the same time in Europe at the time, that you had the joint stock company, which changed everything, and then the stock market, which changed everything, brought by the Dutch to New York, blown up to this massive scale that you and I can sit down today and really sit on the shoulders of giants that came here before us and benefit from the fact that we can own those businesses. And that's to me, it's such a fascinating idea. The one thing I want to add is when I think of the families I work with, many of them have made money in a single business. It might have been multiple generations back. It might have been in this generation. And they realize, and it's a fascinating moment, and I talked to somebody not long ago on the show about it who works in family offices, how they experience this revelation that the wealth going forward will not be in a single business. It will be in a collection of businesses. And you and I step in, and we are that transition, that bridge, where we say, this is the family fortune, and these are the businesses that family should be in. The family fortune should be in going forward. And those families appreciate the fact that they are tapping into this new entrepreneurial spirit, and they can participate in a collection of businesses instead of one. I write about it in my book, Money Life Family, where I studied some of the most successful families and some of the biggest failures in wealth preservation. And I realized it's such a fascinating moment of transition. And some families have succeeded to keep their wealth over generations in one single business, but Jeremy, it's more of an exception than a rule, because there's so much innovation and change that you and I know that you can name a handful of companies, maybe Coca-Cola is one of them, where you could have stayed in one single business. I call it infinite horizon and finite assets. The businesses will have to continue to change because businesses will innovate and disrupt. And the top 5 of today, I almost can guarantee that they will not be the top 5 100 years from now. And we have to keep on moving along to the best opportunities that are out there.
There's an interesting, I did a little bit of research on I looked up the original Forbes list. And so everybody will have to do this. Don't quote me on this because it's been several years since I did it. So let me see if I can remember roughly the stats. The original Forbes list had 30 families, I believe, on it. And it was somewhere around the time that we're talking about that Coca-Cola went public. Maybe it was the early 20s or the late teens or something like that. And you wouldn't recognize most of the families on that list today. There were a handful, I think Rockefeller, maybe Carnegie, a couple of families on there. You'd say, yeah, it's a fun exercise to Google it and look it up. There's a few that you'd say, okay, I kind of remember them. And then if you look up the other families that you haven't heard of, they were a big deal in their time, but we don't remember them. And the reason that this is interesting is because to get on the Forbes list at the time was really a big deal. I mean, there were very, very few people that had that much money when the U.S. especially was so undeveloped. And why aren't those families still on the Forbes list is the bigger question. So today the Forbes list talks about, I think that it's as its title, 500 rich people, 500 of the richest people. And I think to get on it, you now need 4 or 5 billion. And there's a global list as well. But the interesting fact is that I don't believe any of them that were the top of the list back then on the list today. Or if they are, maybe there's one, maybe there's an heir to the Vanderbilt fortune or something that's still kind of maybe at the bottom of the current Forbes list today. But why is that? You had such a long runway, and you were by far the wealthiest people in the world, and much wealthier in those terms than you would have been today in modern terms. So and the exercise they did was take the net worth, the stated net worth of the family at the time, discount it back to what that would mean in today's dollar terms, and just put that money in the index. So at the time, it would have been the Dow or then the S&P 500 was started shortly after that, or maybe a few years after that, and just put it in those indexes, one of those indexes, that amount of money, and carry it forward the whole time. And the interesting thing is, those people would be worth more. Now, you need to do the math yourself, but I remember doing the math at the time that those 30 people would be worth more than all of the Fortune or the Forbes 500 list today.
Hmm.
And it's because of the compounding of putting it in the market and letting it go that whole time. Now, that was probably not realistic to do because you had people dying, you had all kinds of things happen in a family that money needed to be sold, or there was probably inheritance taxes that needed to be paid, and all kinds of things that happened. But it's just a fun exercise that even if to say, what if they would have just put 10% of their net worth at the time in the index at the time, which evolved into becoming, maybe it was the Dow that kind of could have transitioned to the S&P 500 or whatnot. Pick your index, your US index. If you would have just put 10% of the net worth into it, what would that be worth today? And it was some, very, very top of the pile of the current Forbes 500 Forbes list today. And during that time, so I went back and looked at what happened in the last 120 years that would have caused a family to not have kept their money in the market. Well, all kinds of things. The 1920, so the Great Depression, first of all, we had multiple plagues. We had the Spanish flu. We had all kinds of things. We had 2 world wars. And a lot of little things. We had the Spanish-American War. We had the Cuban Missile Crisis. We had so many things happen. We were moved off the gold standard. People were scared of that. We were kind of somewhat of a new country with new country risk, and there was all kinds of volatility before the central bank, the U.S. central bank was created and formed. So there were so many reasons why people would have been afraid to put even 10% of their net worth in the market and hold all that time. And it's so easy to look back on that and say, yeah, but you had the flu, you had all these things. But so why don't people do it today? So if it's so different today than it was, let's say 1919 or whatever that first Forbes list came out, and again, somebody needs to look it up to correct me on the date. Why can't people do that today? Whether it's with the help of a wealth manager or just owning an index or just being fully invested, once they have that kind of net worth, why doesn't that just continue on with that data, that richness of data that we have? Well, people today face the same emotional crises that they had back then. The fear of the unknown, the fear of volatility, the fear of not understanding what they own, the need to feel like they control it, otherwise they can't invest. And so it's just a fascinating thing to think about that, it takes. I love what you're doing, and I love that you recognize that you need to work with the right families. But one of the greatest advantages you bring to the table is that conviction that you really can't transfer these companies that you know well in order to hold them when others can't hold them, and to stay invested for the long run.
I'll tell you that there are people doing the right things for the long run as we speak. I know that they exist. I know them. I also know people that have been doing it for decades and have been very successful and not very visible, quietly putting money to work. But you bring up something fascinating, and I have so many thoughts about it, but I'll start with my personal story. So I was born in Poland, and I got to see the last decade of Cold War Poland, communist Poland. And I grew up with stories of certain affluence in my family a couple of generations back. So I always thought that there was something. Why isn't it here? And it's an experience that I've shared with other people, and I've heard stories like that. I recently met somebody that was their kid, some of the wealthiest European families that no longer have any meaningful assets left. And I was always fascinated with the long-term preservation and the presence of this capital today, after so many years, still with us, still here. Poland had one of the worst locations because on one hand you could create wealth, 100 years ago. On the other hand, you were about to face 2 world wars and then 50 years of communism. So if it wasn't burned down, then it was stolen or confiscated. Not a place to preserve wealth. There are periods maybe to create wealth. Now the US is a phenomenal success story of at least 200 years, if not more, of wealth creation. I listened to an interview of the late Lewis Lapham, who was a Harper's Magazine editor, and he wrote and shared the story how the US was built most of all to be a place of growth, acquisition, and preservation, protection of wealth. And I think it's a fair, important point when people try to compare the world and the regions. The US was built as a place, and still is, to start businesses, create businesses, grow wealth. And it has a setup that allows us to keep it. Throughout history, if you got a little bit too rich, and I had some guests that study the history of wealthy families in Europe through the last 500 years, somebody would walk up and want what you have, one way or the other. Whether it was a prince, an emperor, or a neighboring nation.
Today, Bogumil.
But the U.S. as such has a massive protection, protection of property rights. It's something that we take for granted. So I hold it deeply, and I think this underlying my personal why is that I would love to see that no family should start with zero all over again. We're not just talking about the richest families, but in general, as much as some people live paycheck to paycheck, I want to take it a step further and imagine that no family has to start with zero all over again. But that's been the experience of most of humankind, that with every generation, I meet people who made money in this generation. They say they started with nothing, and they don't want their kids to start with nothing. And they want them to have something that will give them the opportunity to make different choices, freedom, and so on. It has some importance to them. When you start planting trees for other people to enjoy, as the saying goes, there's something fascinating that happens. And I talk about the fact that when you think of knowledge, you and I are fascinated with the acquisition of knowledge, not just investing, but in general understanding the world. We don't start with nothing with each generation. It's not that we burn all the books and Jeremy and Bogumil starts figuring out if the sun is in the middle or the earth is in the middle. We're building on top of other people that have figured so many things out, including, math and physics and vocabulary and language and accounting and all the structures we even talk about. Joint stock company, you just say it with a couple of words, but the thinking behind it, what does it even mean? Like, we're building on structures that have been in place for a long time. Now, when it comes to money, somehow there's a wipeout after a wipeout and after a wipeout. And you point out something fascinating. I had Victor Hagani, who was one of the partners of Long-Term Capital Management, who, as you know the story, but he wrote a book, Missing Billionaires, where he asked the question that you were asking a second ago, because he took the richest families in the US 100 years ago and he put their imaginary money into an index fund. And he said, we would have had a lot more billionaires than we have now. Everybody says, why do we have billionaires? And people get upset that there are so many wealthy people, but flip it on its head and say, we should have had a lot more among us with billions of dollars, even with the wealth that was created 100 years ago, reinvested in businesses that followed, but it's not the case, right? It's fascinating. That's why I started this conversation with the fact that a family fortune is a miracle. There is no dress rehearsal. It's a once-in-a-lifetime opportunity. Get all the help you need to figure it out, because there will be poor investments, there will be overspending, there will be panics, there will be all kinds of things that will make you worry. I want to kind of make a blanket statement. I have this friend that will join me on the show, and we'll talk about his book about big trends. His name is Philip Hazels, and he's from Belgium, and he has a quote in his book where the quote is basically that says, the kids are no longer respecting the parents. Everybody is, self-obsessed. The world is coming to an end. Basically, the world is about to end. And underneath that quote, he says it was written and found on a clay tablet from 5,000 years ago. So already 5,000 years ago, everything that could go wrong was going wrong, according to somebody that wrote that clay. But you could take that quote and put it on Twitter today, and you probably will get 10,000 likes, because everybody thinks the world is coming to an end. So your big point was that people are not joining what Nick Murray talks about, this huge value creation, wealth creation opportunity because they're scared out of the market. It's not that there are no opportunities, because new businesses will come, new products will be provided. I can tell you for sure that new entrepreneurs are being born as we speak. I can also imagine how many new businesses were created during COVID that are just percolating and becoming bigger, that will be listed in the next 5-10 years, and I'm excited to see them. But that's not enough. You have to have the conviction, the confidence, the competence, whatever you call it, to go in, buy those businesses, and not just buy them. Actually hold them long enough. The way we were talking about Coca-Cola, if you just blindly held Coca-Cola, and Coca-Cola is one of many examples, but there were so many businesses that created so much value for all of us throughout the last 100 years, and I'm so excited about the next 100 years. I can only imagine how many leaps in productivity, innovation,
yes,
and everything else that are about to happen in front of us. And I'm 44, and I lived through so much change already. I was on the floor of the New York Stock Exchange in 2005 when I came to New York to accept my first opportunity on Wall Street. And I was on the floor, and they had paper sheets and handheld, huge, like tablet-looking things to coordinate, to execute trades. And one of the floor traders took me aside and said, "Kid, take this one little ticket that said bought sold on top of it, keep it somewhere, but because this will go away, and there will be no floor traders on this floor soon, and this will be a quiet room, and this will all be computer traded." And this guy knew, because I went to Wall Street, to the stock exchange in 2019 with one of my interns. I was curious. The stock exchange in New York, beautiful building, lots of history. And I love that part of town, narrow streets, and each building was some sort of a bank at some point, and you can actually see, the images and the sculptures. Yeah, that you can feel the energy and the presence of the past, the railroads, the shipping companies, and all those, and they're actually engraved in the buildings. They're part of the history. Anyways, I'm standing there in the middle of the stock exchange, and it's as quiet as my grandma's basement. It's just as computers whispering, and there is a TV set up like for the newscasters, but they're quiet until they're on TV. So they're actually, reading their notes, preparing. So it's quiet. It's like a library at school, at a university. And then you can hear, them start talking because the cameras go on and they're reporting why the market is up or down. Nobody really knows why the market is up or down. We're kind of creating the narrative. There's so many books about the narratives. Aswaf Damodaran wrote a book, and Robert Schiller wrote a book about the narratives. So we make up the narrative why the market is up. So they're standing there in the middle of the stock exchange with no floor traders anymore, right? So the paper is all gone. There are no stock certificates. And that's only, 20 years of history. I got to hold some of the last paper stock certificates that some clients brought in a box. Jeremy, it's the coolest thing to think about, that you actually get a physical expression of your ownership of the business. I had Lauren Templeton on the show, from the Templeton family, and she told me that as a kid, her parents, if she bought shares, they would give them her the shares, the certificate, and she would put them in the frame and put them in her bedroom, because she thought that this made her feel like she actually owns those businesses, and they're not for sale. They're not just a line on your app in the phone that says you have 100 shares of this company. She felt like she physically owned them, and I think we lost something by, getting rid of the certificates, because it's so much harder to take that certificate to your broker and sell it, too many steps. And if it's in a beautiful frame and so on. But I feel like it's way too easy to sell. That's why I say everybody can buy. But as you pointed out, so few of us can actually hold. And that's where the value creation happens. Can you hold? Yeah. Can you hold for the easy? Can you hold for the hard? Can you hold for the times when whatever the neighbor is holding is going up faster than what you're holding? I think it's the hardest thing. But it's doable, and people are doing it as we speak.
Yeah. Well, it's been a fascinating conversation, Bogumil, and I think that's a great place to leave it. And I love what you're doing, and I know you're going to continue to be successful, and look forward to more conversations in the future.
Jeremy, I just want to say thank you. I really appreciate it. I loved having you on the show last time. I really enjoyed having you today, and all your questions are very thoughtful, very deep. You and I are trying to do the same. We're trying to become long-term owners in businesses. We realize we need partners on this journey. And we're very selective about who it is. And we both would love to own those businesses for the long run, and we need people that can think that way. And I think we both realize that it's a certain personality, it's a certain capital that can be permanent capital. And then we grow to appreciate a certain type of clientele. And the world is really big, and there are so many ways to make money, allocate money, and invest money. If you find a way that works with your personality, with a group of people that respect what you do and can trust you, I think you're set for life. You're going to have fun. And I'm having the best of times. And I love what I do. And I can't imagine doing anything else. I wake up thinking about what I do. I fall asleep thinking about what I do. So when people tell me, is it a 9 to 5? No, it's an obsession. It's a passion. It's a lifetime pursuit. It's like, and I know you're the same. It's not like, if I find a story, a stock, a conversation I find fascinating, whatever day of the week it is, I'm on it. I want to continue that conversation, and I find the pursuit fascinating. And the more I learn, the more questions I have. I'm very excited about what's ahead. So, Jeremy, thank you so much for today. This was such a blissful conversation. I appreciate all the questions.
Yeah, thank you for talking.
You were listening to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest subject of all, money. But our conversations lead us to an even bigger question: what it means to live a rich life beyond money. If you enjoyed the show, please take a moment and follow, subscribe, rate, and share with friends and family. We rely on word of mouth to promote the show. One click for you means the world to us. Thank you. Until next time, your host, Bogumil Baranowski.